I think from an equity perspective, as you know, the direction, I believe is certainly down. I am very keenly aware that we've seen in all bear markets that you get very sharp rallies within those bear markets. A lot of times those rallies can come from headlines where governments are trying to do things artificially to help situations which long term have no effect or potentially a negative effect, but in the short term can create short covering rallies.
If we look at the current sentiment, you mentioned initially that consumer confidence is basically at a multi-decade low. It seems as if investor confidence is also very, very low at the moment, but there is a huge discrepancy compared to the actual positioning of investors. You have a tremendous chart on this. Please take us through your thinking of why we see such a scenario right now with low sentiment, but actual positioning in the other direction.
Yes, this is a very important point. So over history, what we have seen is that investor confidence and consumer confidence are highly correlated to the individual investor's allocation to equities. So the world gets more challenging, investors lose confidence, they reduce their holdings, their allocation to equities because they know this is the riskiest investment that they likely have in their portfolio, is also liquid, and so they reduce the allocation. And it has moved, it's been highly, highly correlated with this investor and consumer confidence over time. And what you're seeing right now, which is highly unusual, is that consumer and investor confidence is at the lows, yet equity allocations are at the highs, pretty close to the highs. So why is this happening? So one of the things that investors have been trained towards in the past, really since the financial crisis, has been that downturns are going to be short and stock market downturns are going to be particularly short because we will always get fiscal spending and monetary stimulus to essentially save the markets. And as a result, you may take pain for a little bit, but stocks always bounce. And you really need to go, prior since, 2009, that's been the case. Now we're on to the 13th year of this phenomenon happening. And so I think the mentality of the individual investor has been twofold. Number one is I don't need to sell because I know stocks will bounce back. They always do. And then number two is they haven't necessarily adjusted to the higher rate picture that we're seeing globally. And for all of us that are in the investing world, we live the higher rates every single day. But for the average individual investor out there, they really haven't looked at fixed income. That is close to historic low allocation for some time because those yields across all instruments, not just treasuries, but across municipal bonds, preferreds, et cetera, have all been too low. And so that adjustment period saying, oh, there are alternatives to equities, I think is just going to take time. And so what does cause the individual investor to actually then reduce their allocation? And I think one of the big catalysts is going to be price, where right now they're already underwater. About $1.5 trillion has been added to equities in the past, call it year and a half. And the average cost is higher than where we are now. Not significantly so, but higher than where we are now. And so once that pain becomes large enough, I believe that they will end up to start reducing their position because just like anyone in a losing position, at some point you can't take the pain anymore.
If we look at the current era with low interest rates, central banks always helping markets when needed, etc. We probably also look into a set of investors that are born and raised to a large extent in the era of the Federal Reserve put. And the interesting thing here is what happens if that put option is no longer in place? What do you make of the debate on the level of the current Fed put and whether it is at all in place anymore?
So, essentially, I would say it's not in place. And as you pointed out, it's a huge change from what we've seen. And not only is that not in play, but from a fiscal standpoint, we're going to have the midterm elections in just 5 to 6 months from now. In all likelihood, the Republicans will take at least one of the houses. And so the fiscal spending outlook for the next 2 years, really 2.5 years, because it's really from now, there's going to be no bailout for markets or for the economy based on those dynamics. So the fiscal put option is definitely not there. And from a monetary standpoint, I think that there is a level where the Fed stops hiking. But, it's hard to really call that a put option because I think they're going to be far, far away from cutting rates and far away from, since they just started QT in the past 3 weeks, to think about them, stopping it and then reversing and going the other way is just, a pipe dream and just very, very far out. We would have to see much lower prices. I mean, prices that we can't imagine, I think, for that to happen. So it really, it's a huge change from what we've seen since the financial crisis and cannot be underestimated. There's no, there's no support. There's no down support for this market where the market can get bailed out. And that's a big difference. And that increases the risks in equities.
That's a really interesting point, Eric. We talked about positioning in equities still being quite optimistic, actually, when you look at the actual positioning versus this very downbeat sentiment. What would be the trigger? What are you looking for in terms of triggers for a change in the actual positioning in equities?
There's going to be a point where savings continues to be depleted, which is happening, as we speak. You can see some of the credit data, which was dropped to well below trend post the bottom of the pandemic, and has now gone all the way up to trend and actually potentially a little bit through trend. So, and then if you look at some of the other figures around deposits, et cetera, it does appear that, most of the excess savings has now been depleted. And so if you get to a scenario where unemployment starts to tick up, which I think is going to happen, and you have a scenario where asset prices continue to fall, that there's going to be a situation where they're going to be they're going to force themselves to begin to liquidate. And that's where it can feed on itself and become somewhat self-fulfilling.
If we look at the equity valuations entering into this kind of scenario, how would you describe equity valuations as of now? Are equities still expensive in a historic context, or are they starting to look more average? What would be your assessment of that?
So, I'm believe that they're on the expensive side. And so I think one of the important points is that, we look at, for valuation, we look at the equity risk premium. I've been looking at the equity risk premium as the valuation metric for, call it, 15 plus years. And essentially that is the inverse the PE, so it's the earnings yield, minus the 10-year yield. And as we know, everything in this world is relative. So in the 70s and 80s, when the 10-year was trading in the teens, you had equity multiples that were went as low as the single digits. And if you're going to have a 10-year in the teens, you really have to be rewarded in a big way in order to own equities to try to outperform that return. And so in order to get that, you pay a lower multiple for equities. So and then to take the other extreme, we had the 10-year yield hit 50 basis points and the multiple went up to 23, 24 times, which makes sense because you're not getting any yield. And so your level around what you're willing to pay is going to be a lot higher for equities because you're not needing as high a return. So we think that this is the way to look at it. And if you look at the equity risk premium, it's actually this year it's declined. So right now on forward earnings, it's about 2.75%. The average over the last 5 or 6 years has been about 3.5%. And so there are a number of reasons why we think that equity risk premium should be higher, much higher than where it is right now. Number one, the risks are higher. We can see that in credit spreads. We can see it in commentary from corporate CEOs like Jamie Dimon saying we're preparing for a hurricane. You can look at all the recession models, which have significantly ticked up. We have inflation at 40-year highs. We have an experiment going on with unwinding a $9 trillion balance sheet. And so risks are clearly higher. So for that reason, we think it should be much higher than it is. And then the second thing is if you look at prior equity bear markets, the year 2000, 2001, 08, 2018, 2020, the equity risk premium rose in each of those situations by anywhere from 200 to 500 basis points. And so, and then one more stat around that is that 7 of the last 9 years, the equity risk premium has gone above 4%. Okay. So you have a lot of data in there that would suggest that the equity risk premium should be 4% or higher right now. And it's not. And to put that in perspective for the S&P, if you take the equity risk premium to 4% right now, that equates to about 3,250. If you take the equity risk premium to 5%, it equates to about 2,900. Okay. There's other metrics, and I would put two other metrics in front of you. One is to look at the capitalization of equities to GDP. And right now we're higher than where we were at the peak in the year 2000. And then you can look at dividend yield relative to the 10-year yield. That is at a 5 to 6 or more year low. So I don't see any metrics that would suggest that stocks are undervalued despite the sell-off that we've seen.
If you look at 12-month forward-looking multiples such as price earnings with expected earnings over the next 12 months, for example, then I actually think that you can make a case for equities looking cheap, at least on paper. But there's an important point to be made in terms of such forward-looking indicators, and that is that they are based on analyst expectations. And the big question mark now is whether these earnings expectations will hold true. And I have my doubts. Do you have doubts around the earnings expectations as well?
I do. One of the things, and I think we're going to see it show up in this quarter's earnings and guidance. If you look at the trends, one of the things that we've learned post-pandemic is that the activity that happened after the pandemic is causing a lot of skewing of data, right? And the pull forward effect and the underlying metrics within equities are a good example of that. So margins right now, if you look at operating margins over the last 7 or 8 years, they've trended right around 13% every year. And then in 2021, they spiked to 16%. Mm-hmm. Analysts are expecting that 16% to happen in perpetuity. If you look at return on equity, if you look at return on assets, mm-hmm. those were all well above trend in 2021. And the assumption is that also will continue. And the market, as we know, has already sort of mispriced a lot of pandemic winners, where the market thought that a great percent of their prosperity during the pandemic would continue in perpetuity. We know that has now not happened. Now the market's saying that the margins and the returns are going to go on, for the foreseeable future. We would argue that's definitely not going to happen.